Hello everyone, welcome back to this channel. Today I am going to tell you about how to save your tax by section 54 EC. Is it a smart move to save your tax to opt this scheme under investment under section 54 EC in capital infrastructure bonds, and what will be the effective rate of interest you will get after post tax benefit? So let's continue. What is 54 AC? 54 EC is a section where you can invest, where you can save your tax, capital gain tax, by investing in capital infrastructure bond. Section 54 EC of Income Tax Act 1961 provides that capital gain arising from the transfer of long-term capital asset, being land or building or both, shall not be chargeable to tax in case the amount of capital gain is invested in capital gain bonds. This section has been amended recently by Finance Act 2018, whereby lock-in period of investment in such bonds are increased from 3 years to 5 years. So, according to this section, you can understand that if you are investing such kind of bond, so the lock-in period from financial year 2018-19 is increased now by Finance Act 2018, but you can invest in these such kind of bonds by selling and by saving this capital gain tax of which is from land and building or both. Further, the benefit of this deduction has been restricted to the long-term capital gain. It will not available for short-term gains which are arising from transfer of land or building or both. So it is restricted to long-term capital gain. Long-term capital gains in land and building means if you are transferring your land and building after 3 years. Entities which issues capital gain bond as on date, there are 4 entities. All are AAA rated and which are empowered to issue such kind of capital gain bonds. Let's see what are the entities. First is Power Finance Corporation Limited, PFC. Second is Indian Railway Financial Corporation Limited. Third is National Highway Authority of India Limited. Fourth is Rural Electrification Corporation Limited. Next topic is, now let's go to look at whether the investing in such kind of capital gain bonds is a smart move to save your capital gain tax, considering the coupon rate of these bonds is currently 5.75% per annum, and there is a lock-in period of 5 years. So LTCG means long-term capital gain arising from transfer of land or building or both. If the investment made in these capital gain bonds specified under section 54 EC of the Income Tax Act 1961 are exempted from tax. However, in order to claim this deduction, one need to invest in these bonds within 6 months from the date of the transfer of capital asset. Further, the maximum amount of LTCG that one can invest in these bonds are 50 lakhs. So, after listening these lines, what we can understand is LTCG arising from transfer of land and building, you can save up to 50 lakhs. The maximum threshold limit for this is 50 lakhs. Lock-in period is 5 lakhs and the investment should be within the 6 months from the date of transfer of capital asset. And which kind of capital asset? Capital asset will be land or building or both. So you can invest capital gain in these bonds issued by 4 infrastructures notified by the government companies. Thus the amount of LTCG works out of rupees 60 lakhs. Then one would be able to save the tax. By the way, section 54 EC is only up to 50 lakhs. So you can save up to 50 lakhs only by investing in these bonds. However, in case of when you hold jointly held property or real estate, each owner has a separate limit of rupees 50 lakhs. So that's the good thing about this section. Each owner will get amount of rupees 50 lakhs as an exemption, as a deduction. So the total amount will be 1 crore. So if one decides to invest in section 54 EC bonds, it will fetch the return of 5.75% per annum, which will be applicable at the slab rate. Means this return will be chargeable to tax at the applicable rate of tax. But one will be able to save the LTCG tax of rupees 10,40,000, which will be comes amount LTCG at the rate 20.8% in the first year itself, and the effective rate post tax return rate will be 9.35, considering the highest marginal rate of tax, that is 31.2%. In case one decide to pay LTCG tax and invest the net amount of rupees 39.60 lakhs. Capital gain is rupees 50 lakhs and LTCG is rupees 10 lakhs 40,000. In other words, fixed income securities for earning the same post tax return of 9.35. The securities would need to pay interest rate of around 13.5%, which is currently not being offered by any government entity or AAA rated issuer. One could also look at the investing point of view, investing in a mutual fund, but the return of there are not guaranteed, because in mutual fund all are subject to market risk and you can't get guaranteed return. Hence, investment in capital gain bonds would be a smart move if one wants to save the LTCG tax and avoid the market risk and earn a fixed rate of return from the investment and not ready to take any market risk.